Hello everyone, welcome once again to Promise. There is A-level economics by Ngum Promise. If you are new in the channel, please just help subscribe to the channel and also click the notification bell so as to be notified when I drop questions. That is question and answer sessions. So today, please, we're going to work on all possible questions on ammonia banking. The possible questions that can appear on ammonia banking with their interpretations and answer guides. The very first question we shall be working on that is, how do commercial banks create credit? Are there any limitations in doing so? After reading the question, you can hear credit creation, and you can also hear limitations of credit creation. So to interpret the question, the first thing you're supposed to define credit creation. Yes, define credit creation as the ability of commercial banks to increase the amount of money in circulation or to increase the supply of money. After that, you also mention the various ways through which commercial bank create credit. Yes, commercial bank create credit by accepting deposits, by granting loans, and by buying securities. Yes, you mentioned those ways. After that, you also talk about some of the assumptions of credit creation. If you wish, you can still bring in the assumptions of credit creation before the ways through which it is being carried out. Yes, so after bringing in the assumptions, there's cash. There's a cash reserve ratio of 10%. That's an assumption. Cash is the only liquid asset. Checks are used in all transactions and the rest. Those are the assumptions of credit creation. You also talk about. You also give it 1 to 2 steps of the process of credit creation. Yes, we assume that someone or somebody called Mr. A deposit a given amount of money or deposit 100,000 francs in the bank. The bank will keep a cash reserve of 10% and give out the balance as loan, take it and settle a debt, which permit the person to bring the money back to that same bank and deposit constitute a new deposit. In fact, you explain and calculate the maximum amount that the bank can create. And secondly, you talk about the limitations of credit creation. At least 4 factors that limit the ability of commercial banks to create credit. The cash reserve ratio, the monetary policy of the government, the availability of collateral security, the demand for money, and the rest. Those are some of the points that limit the ability of. So what do you understand by money supply, and critically examine the effects of an increase in money supply in any economy? After reading the question, the only thing I can hear as a keyword is the supply of money. So you're expected to define money supply, or the supply of money, as what amount of money circulating in an economy within a given period of time or at a given period of time. That's what we call the supply of money. And it might be necessary for you to mention that it is the supply of money is regulated or is determined by the government through the central bank, and it is with the use of the monetary policy instruments. Then from there, you also make mention of the fact that from there you talk about the possible. When you hear of effects, it can be a positive effect, it can be a negative effect. So it gives the positive effects of credit of an increase in the supply of money. Because the increase in the supply of money might lead to an increase in the standard of living, it might lead to a fall in the rate of unemployment, and those are some of the positive effects. So you can look for some. We also talk about the negative effects of an increase in the supply of money. It might lead to inflation, it might lead to increase in cost of living and rest. You look for others. Those are negative effects of an increase in the supply of money. So we should examine the instruments of monetary policy and show how they can be used to reduce inflation. Yes, we've heard about monetary policy, we've heard about inflation. So what are we to do? We are supposed to define monetary policy and inflation in the introduction. Define monetary policy as a policy used by the government to regulate or to control the supply of money in an economy. Inflation as a persistent increase in the price of goods and services in an economy. That's the introduction. And the first part of the question, you give the instruments of monetary policy, that's the open market operation, funding, the minimum lending rate, the special deposit, and the rest. That's the first part of the question. Explain. And in the second part, you show how the instruments explained in the first part can be used to reduce inflation. For example, let's talk about with the open market operation, the government can sell securities to the general public in order to reduce inflation. Yeah. If the government sells securities to the general public, what happens? It reduces the amount of money, reduces the supply of money, and consequently will lead to what? A fall in demand, which will keep what we call demand pull inflation. Liquidity and profitability are conflicting objectives of commercial banks. How can these objectives be reconciled? Yes, there are three main objectives of commercial banks: liquidity, profitability, and security. The bank usually seeks to achieve all these objectives. The bank will usually want to achieve the objective of profitability by giving out loans. The bank will want to achieve the objective of liquidity by keeping much money in liquid form, and want to achieve the objective of security by making sure that collateral securities are being presented before a loan is being given out. So in this case, you realize that there is a conflict between liquidity and profitability as objective of commercial banks. Why? Because the bank cannot achieve two at the same time. The bank must forgo one in order to achieve the other. That's why we say they conflict. Then you are supposed to define commercial banks liquidity and also define profitability. Yeah. Commercial banks, they are profit-making financial institutions that accept deposit and give out loans with the aim of making profit. Liquidity is an objective of commercial banks that seeks to satisfy customers when they come in need of cash, and profitability is the ability to make profit from interest in order to pay interest to shareholder, interest on to their customer, pay salaries to their employees, and also pay dividend to shareholders. So explain how liquidity and profitability, that's the first part, how liquidity and profitability conflict. And the clue of it is just that if the bank wants to achieve the objective of profitability, it will forgo liquidity, and if you want to achieve the objective of liquidity, it will forgo profitability. That's just the clue of it. They cannot increase at the same time. As profitability is increasing, liquidity is falling. They are inversely related. So we should show how, in the second part, you show how these objectives can be reconciled. How can the bank reconcile these objectives? The bank can reconcile them by making sure that the assets of the bank are arranged to have a balanced portfolio. That is, to keep more part of the asset, to keep some assets as profitability assets, and this as I always assets like investment and advances, that's investment and loans, and some part in liquid asset, cash at till, treasury bills, money at call and short notice, and the rest. So in order to support your answer, you could still bring in the balance sheet of the commercial bank, showing clearly the fact that when, in fact, as assets are arranged in the increasing order of profitability and the decreasing order of liquidity, you can bring in the balance sheet and explain that notion. Explain the role of the Bank of Central African State (BIAC) in the economy of Cameroon. What role do BIAC plays in the economy of Cameroon? Yeah, it's all about defining, making the examiner to understand that BIAC is a central bank, and you make the examiner understand what a central bank actually means. You give the role that the central bank plays in the economy of Cameroon. That's the functions of the central bank: issuing of currency, implementation of government monetary policy, the bankers bank, lend out last resort, banker to the government, and the rest. So guys, give at least 8 points and explain them. We'll give you oil marks. What are the uses of the retail price index? Just identify the problems encountered in constructing such an index. Yes. So you expected to define what we call the retail price index as a device or as a tool used to determine relative changes in the value of money or relative changes in the price of goods and services. From there, you give the uses of the retail price index. It is used as it is the base for wage claims by workers. Yes, when workers will Retail price index constitutes one of the factors that determines whether workers should seek for higher wages or not. It also used to determine the real national income. It's used to determine what the rate of inflation and deflation, and it's also used to do what, to measure the value of money. If the retail price index is more than 100, means that the value of money has fallen, or price of goods and services has increased and the value of money has fallen. And it's less than 100, means that the price of goods and services has fallen and the value of money has increased. So those are some of the points uses of the retail price index. The second part, you go to what the problems encountered when measuring such an index. What are the problems encountered when preparing a retail price index? There's always a difficulty in selecting the base year to choose that year in which prices of goods and services are assumed to be stable. The problem of selecting the basket of the goods. Yes, some goods need to be selected to represent the entire goods in the economy. We talk about the problem of weighting the product selected. Weights here are referring to what how important the product is to the society. We also talk about the quality of the goods does not always change. Yeah, the quality of the goods does not always change, right? It's a problem. Why? Because we're talking about the retail price index here, measuring changes in prices, and when the quality of the goods does not change, it becomes a problem. There is always a problem of selecting the average family. You need to choose the average family to use their expenditures, in this case to be able to determine the retail price index. So those are the problems. The next question, the franc CFA is money used in Cameroon. Why is it considered as good money? Yes, why is franc CFA considered good money? We actually referring to the characteristics of money. You are expected to define money and also give the qualities of good money. NB explanation must be linked to FCFA. Yeah, when explaining a point, you must always make sure you mention FCFA to ensure or to let the examiner understand that you're actually talking about franc. So some of the characteristics you talk about: portability, homogeneity, general acceptability, divisibility, and the rest, right? You give at least 8 points. We'll explain why money is important in an economy and why do people prefer to hold money in liquid form. Why is money important in an economy? Yeah, from the question you have liquidity preference, you have money. So you're expected to define money and also let the examiner know that when people decide to hold money in liquid form, it is known as what liquidity preference, or the demand for money. And from there, we all know money refers to anything that is generally acceptable or generally accepted for the exchange of goods and services and for the settlement of debt. So from there, you go to the first part by giving what the functions of money. Yes, why money is important. Money is important because it plays certain functions in the economy. Yes, it is important because it serves as a medium of exchange, it serves as a measure of value, it serves as a standard of deferred payment, it serves as a store of value. It should be noted that measure of value is also called unit of account. And that's one name for the measure of value as a function of money. We also give the reason why people prefer to hold money in liquid form, that is in the B part, rather than investing or saving it in the bank. Yeah, there are 3 main reasons why people hold money in liquid form. It can either be for transaction motive, it can either be for precautionary motive, or it can be for speculative motive. For transaction motive is when people hold money in liquid form in order to run their day-to-day activities. For precautionary motive, they hold money in liquid form for unforeseen circumstances like sickness, unexpected visitors, and the rest. Money held for these 2 purposes is called active balance, while speculative motive is for business purposes, and money held for that purpose is called idle balance. The demand for transaction motive and precautionary motive is influenced by the price of goods and services, the amount of income, and the rate of interest. These are 3 factors that influence these are 3 factors that influence the demand for transaction and precautionary motive. While for speculative motive, the demand is influenced by the rate of interest alone. Then please, for transaction motive and precautionary, we have the amount of income. You talk about the price of goods and services and the interval of payment, please, not the rate of interest. The rate of interest applies only to speculative motive. So in this to have they have given you for 12 marks. So in each of the motive, you explain what it means, you give an example, you give an example, right? And you also give what factors that influence it. Yes, that's what will give you all your marks. How has money solved the problem of trade by barter? Yeah, from the question you can hear money, you can hear trade by barter. So in your introduction, define money and trade by barter. Money refers to anything that generally accepted as a for the exchange of goods and services and for the settlement of debt. Trade by barter was a system of trade, or was an olden form of trade where goods were directly exchanged for good. From there, give the various problems of barter system of trade. Please allow me to say something about this question. This question is like an essay questions where you have the given part and the hidden part. That's the first and the second part. The given part is that which you can actually identify from the question, and that is always the part you start with. But when you read the question, how has money for solve the problems of trade by barter? What is coming out of the question clearly? The problems of trade by barter. That's the given part, and that is what you start with. So you start by giving the problems of trade by barter as there was double constants of one, storage problem, measurement problem, and lack of standard deferred payment. Those are some of the problems. Then from there now you show how the functions of money have solved the problems that you have listed up that you have given above. In that case, let's take an example with double coincidence of ones. The function of medium of exchange has solved the problem of double coincidence of one. Why? Because now you can be able to sell what you have and buy what you want. Unlike the case of barter system where it was difficult to see someone that has what you want and also need what you has. So the function, the store of value also solve the problem of lack of storage in the barter system. Measure of value also solve the problem of lack of measurement unit during trade by barter. And the standard of deferred payment also solve the problem of lack of standard of deferred payment during. What do you understand by demand pull inflation, cost push inflation? What measures can be taken to remedy the negative effects of inflation in an economy? You expected to define inflation as a percent increase in the price of goods and services. You give a clear difference between what demand pull inflation and cost pull inflation. A clue of it. Demand pull inflation refers to an increase in the price of goods and services caused by what? Excess demand over supply when demand is more than supply. While cost push inflation is an increase in the prices of goods and services caused by an increase in the cost of production. That's just a clue of it. So the second part, give factors that can be used to remedy the negative effects of inflation. Can be used to correct inflation. You talk about contractionary fiscal policy. Yes, contractionary fiscal policy. You talk about contractionary monetary policy, and you talk about price control policies. Those are some of the points which the government can use to control inflation. You give at least 6 points. You explain them. What are the conditions necessary for commercial banks to create credit? What problems are commercial banks likely to face in creating credit? The first thing, you define credit creation as the ability of commercial bank to increase the supply of money in an economy or to increase the amount of money circulating in an economy. From there, you mention the various ways through which commercial bank create credit by doing what? By accepting deposits, granting loans, and buying securities. Then, the main part of the question talks about the assumptions of credit creation. The conditions necessary for commercial banks to create credit, they are the assumptions of credit creation. Yes, cash is the only liquid asset. Checks are used in all transactions. There exists a single banking system. Any money given out as loans will deposit in the bank. The bank is a fixed may fix a cash reserve ratio of 10% and the rest. So if cash is not the only liquid asset, it means that credit creation will not be possible. If checks are not used in all transactions, credit creation will not be possible. If there is more than the one bank, credit creation will not be possible. That's why we are saying that these are the conditions necessary. Yes, cash must be the only liquid asset. Checks must be used in all transactions. They are the conditions necessary for commercial banks to create credit. The B part talks about the limitations of credit creation, the monetary policy of the government, the inadequate collateral security, the amount of cash reserve ratio, the demand for money, and the rest. Those are the limitations of credit creation. Factors that limit the ability of commercial bank Explain the various ways by which the government of your country can control the supply of money. Why do government control money supply? Yeah, you define the supply of money, right, as the amount of money circulating in an economy within a given time. And in the first part, you give the ways through which the government can control the supply of money. How can the government control the supply of money? With the use of monetary policy instruments. Yes, open market operation, minimum lending rate funding, the directive, special deposit, cash reserve ratio, and the rest. State at least 4 points and explain. 6 points, please, and explain to have all your 20 to have all your 12 marks. Then the B part, the top, you explain the explain the reason why the government control money supply, and it's always needed to achieve macroeconomic objective, like to achieve price stability, to reduce unemployment, to improve the balance of payment situation, to achieve negative. No, please, it's not achieve. It is to you don't say achieve, please. You say it is to control negative externalities, to achieve a balance of the balanced regional development, to regulate the exchange rate, to achieve sustained economic growth. Those are some of the reasons why the government controls the supply of money. But you are expected to give state four, and explain for all your in-mark. Thanks very much for watching. Thanks very much for watching the video today. And please, if you are new, like if you have not yet subscribed, please make sure you subscribe now. And as the video have helped you, please, you also like that it should help others, so please share to the other groups. Let students watch and be, in fact, let them prepare for money and banking. It's a short topic, it's a short question that you will find in the section B part of paper 2. So guys, click the notification bell, like the video. Have you subscribed? Okay, so you can now share to some WhatsApp groups. It goes that way. So guys, thank you guys. Check in this very channel, you will find all possible questions on that theory of income distribution. Check in this channel, you will find many other questions, including tips or including orientations for your GC writing. You need to go into GC with some certain things in your mind. Check in this channel, you will find them. Thank you very much. See you guys in my next video.